The risk of recession in the US has increased recently. So I'm going to outline the four major known risks that we see that are causing that increased risk of recession. And then I'm going to give you four positive counterpoints. So the first risk is the US consumer. Rising inflation is weighing on the US consumer. The University of Michigan Consumer Sentiment Index fell from 88.3 a year ago to 65.7 during March of 2022. This is the lowest reading since November 2011 and near the sentiment levels during the Great Financial Crisis. Wage growth has been great for the last few years. But if you have inflation that is really above trend, then the US consumer isn't really making any headway with their real income growth. So the US consumer might be pulling back discretionary spending to make sure they have enough money for the necessary spending they need to live. The second risk is the Federal Reserve. They're embarking on a policy shift. They're going from aggressive stimulus to tightening. So during COVID and during the stimulus during that time, the markets boomed, the economy was doing well. So now that the Federal Reserve is raising rates and trying to pull some of that stimulus back, will we expect the opposite to happen? And the Federal Reserve is in a tough spot here. You have inflation. Now the year-over-year number should improve, but you still have these high inflation rates. So they got to show that they're tough on inflation without tipping the economy into a recession. The third risk is politics. The current administration has a choice between runaway inflation or a cyclical recession. Now, a cyclical recession is a normal part of the business cycle. No one likes it, but that's an easier story to spin. Runaway inflation can lead to a lot of big unintended consequences and big problems like food shortages. And if you have any food shortages and just high costs running rampant, that's political suicide. So if you were in power, would you choose the recession or would you choose the runaway inflation? You're probably going to lean more towards the recession. The fourth risk is geopolitics, and more specifically, the war in Ukraine. Now, we put this in the category of a known unknown. We know that it's risky. We just don't know how much. If the war just kind of contains itself in Ukraine, between Russia and Ukraine, maybe it's less risky. If it spills over to other borders and pulls into other countries, well, that risk elevates. All we really can say right now is that it's a tragedy happening in real time and across social media. And from a risk perspective, what we need to do is account for higher asset class volatility. And there's going to be unintended consequences and big fallout from it. You just can't take two of the biggest wheat producers off the market and not have global economic disruptions with it. This is not an exhaustive list. This is just four of the major risk factors that we see that are driving the risk of recession upwards. Now let's look at four positive counterpoints. The first positive thing is M2 money supply. The M2 money supply is cash, CDs, checking and savings deposits, and money market funds. And that's sitting around $3 trillion, which is above the pre-COVID trend. This is a lot of excess liquidity out there that can support consumer spending with rising prices. The second item is corporate profits. Corporate revenue growth, and profit margins for publicly traded large, mid, and small cap companies are near all-time highs. So even with inflation, they've been able to pass those increased costs onto the consumer and maintain their margins and maintain their cash flow. The third item is peak inflation. The fear that we're entering an era of just unrelenting price increases is probably overdone. We're now entering a period where the year-over-year comparisons are going to be good. Last year's numbers are really high. We're still probably going to see inflation above 2%, but compared to last year's high growth, it's going to be a lot less. So less inflation growth might push the Federal Reserve to take a less aggressive tightening position, so it allows some more of that stimulus to stay into the economy. The fourth and final positive counterpoint is the credit cycle. When you think about the worst recessions, now the 2008 financial crisis, the housing bubble bursting, that was debt-driven. That's the credit cycle. We're not in that same position. The key metrics that would be showing stress, like increased defaults, increased bankruptcy filings, high yield spreads widening, corporate profitability declining, we don't see that right now. We're just not in the same position that we are at like a debt-driven recession. Recessions are really hard to predict. The Nobel Prize-winning economist, Paul Samuelson, once made a joke that economists have predicted 9 out of the last 5 recessions. And if we do have a recession this year, it's going to be one of the most anticipated recessions in recent history. CNBC did a poll, and 81% of adults said they expect a recession in 2022. And we're not making a recession prediction here. We're just seeing the signs of increased risk. If the normal probability of a recession in a given year is 15%, we're now bumping that up to like 25, 30% for a recession in 2022 to 2023. What we're trying to do is we're trying to understand the current market conditions, and we're trying to position the portfolio to take advantage of those conditions and any dislocations that a shift in sentiment or a shift in the economy may cause. If you would like to learn how we're positioning portfolios to take advantage of the current market conditions and where we're finding good risk-reward profiles for certain asset classes, then download our recent quarterly letter. There's a link down in the description to do that. And if you want to watch some more videos to learn about our portfolio management style, you can check out these videos, and please hit subscribe.